All right, a lot going on, Simeon, a lot going on. I want to get your word of the day. How do you see today shaping up?
My word of the day is income.
Wait, with everything going on, your word of the day is income?
My word is income, but let me back up because we do have to address the issues of the day. And geopolitical volatility, the strikes, those are a real thing. But you have to put this in the context of what we've known for a couple of weeks now, the dovishness of the Fed and the 50 basis point cut. That was a gift to equity investors. You noted only 1% off the all-time highs, but it's a salary cut for income-oriented invested. But look, the fixed income market still has enough yield to bail you out if the geopolitical tensions get worse. You still have almost a 4% yield on a 10-year bond. You could see that go to 3% or even lower if something really bad happens. So you still have the opportunity to make 10 or 15% on bonds in a real world of turmoil. We haven't had that opportunity in a decade.
You know, in all fairness, we're about 3.76, so it's not actually that close to 4%, Simeon. Just in all fairness.
It's a rounding.
Okay, you're rounding up, all fairness. Surprised we didn't see a big flight to safety, 2 bonds yesterday with all the tensions?
Well, we still have good news, good economic news in the U.S. You have the 50 basis point cut, but you also have the soft landing that looks like it's in hand. We had a low PCE month over month, just 0.1%. So if you can perhaps divorce yourself from the geopolitical tensions, the state of the world in the U.S., again, much better than the rest of the world and looking pretty good from a solid economic footing.
All right, I want to talk about 2 areas going different directions. We talked about defense stocks. I want to keep this quick because we want to get to your pick. Defense stocks moving higher on the tensions. Then we also saw Nike moving considerably lower after withdrawing guidance. Are you seeing any opportunities in either one, more upside for defense, more or possibly a rebound in Nike with the new CEO taking over?
The Nike issue is very idiosyncratic. However, it does point out that the better positioning is in staples rather than discretionary right now. That's for sure. If you look at the charts for things like Colgate and Clorox, you see them really rallying over this summer as that rotation from the mega caps kicks in. All
right, very quickly, your pick for us is a covered call strategy on the Russell 2000. I'm looking since the rate cuts. It's actually underperforming the S&P. You got to give us the elevator pitch. I2 is the way you're playing it, the ETF.
For the first time, a daily covered call strategy allows you to have the income that you need to replace those 50 bips you just lost, but still have a bullish position and participate. Rate cuts have historically had an outsized positive impact on small caps. Now you can actually generate the income from covered calls, but still participate in the Russell 2000.